Hey everybody, Signet here with the Bullish Bears, and in this video we're going to cover another day trading options tip. This is video 3 in the series, just trying to make these short and sweet, covering one small particular topic at a time. We'll just work our way through and get a whole variety of different things. In this video, I want to talk about trade management and the choices we make as we're building the trade, thinking ahead about what are we going to do with the trade, whether it goes good or it goes bad, besides closing it down. I really want to stress you can always just close the trade, just get out. There's nothing wrong with that. But that's the obvious solution. What else can we do? So when it comes to day trading, one of the things that I like to focus on is locking in the trade in such a way that I cannot lose, while also still hanging on to the trade and giving it time to kind of grow into something more, right? A lot of times when we're trading options, there's a discussion about staying in it long enough to be proven right. Well, how can we do that when the risk is really big, or if we're worried that we're going to see our gains fade away through the day? So the idea is to approach this and deal with this situation as we're getting into the trade, having this in mind. So one of the things I want to point out is we're not talking about trading something on the last day. We don't want to use 0-day options in this situation. If you don't know what a 0-day option is, it is an option that is going to expire today, right? We don't want to trade those. If you're looking to buy a call or buy a put, which is really what we're focusing on, this isn't about spreads yet, but we're going to walk into that in just a few minutes. But we're talking about wanting to buy a call or wanting to buy a put in the understanding or the belief or the idea that price is going to move somewhere today, and you want to participate in that move in an options trade. So we're going to buy a call or put. We do not want the 0-day. Okay, there's a couple of reasons for that. One of them is that the decay of that thing is just really extreme. And you can be absolutely right. You can believe the stock is going to go up, buy a call and see the stock go up and still not make money. Because at that point, trading that 0-day option, if it doesn't go up far enough, and if it doesn't go up fast enough, you're not going to make money. And as soon as it quits going up, as soon as it quits moving, your gains are instantly going to start fading away, and you have to lock in that profit really fast. So we just want to avoid those right off the bat. I would even say avoid it past Tuesday, maybe into Wednesday morning. Just start looking farther out. Now, obviously, you don't need me to tell you about which strike to trade. If you're already an advanced trader, you understand the risk of trading a 0-day. It is a profitable way to trade if you've got the skill set for it. But let's just leave those alone and focus on something else for the rest of us. All right, so that leaves one series out. A series would be, April 22 is a series, April 29 is a series, May 6 is a series. So if we're not focused on the front series, which is the one closest to expiration, then we want to look at least one series out, maybe two. That's the first step. When you're then thinking about the option that you want to buy, already be considering, what are you going to do if you're wrong? So we're looking at Bank of America. Suppose I bought the 38 call and I spent $71 for it, which is the midpoint between the bid and the ask. So I buy this thing, I spend $71, and as soon as I get in, it dumps. Now I bought a call. I don't want the stock to go down, but that's what happens. I get in, I buy the call, I'm ready to go. The market dumps. What do I do? Now, remember, we can just close the trade. We can. But what else could we do? So if I had that one already in my hands, what I could then start thinking about is, can I sell an option? Now, remember, I spent $71 to buy the one that I've got. If I sell an option, I want to make sure that I'm getting more than that because I need to get my money back, right? Well, I can see that the next strike in is $93. And I just built this spread showing how we construct a credit spread. But remember, we start with that long call. So if we get in, price is at support, we think it's going to go up. It breaks support, starts falling to the downside. We immediately sell that next strike up. And the difference between these two options, that will be our credit for the trade. It's not a very good credit. You can already hopefully see that. This is a 50-cent wide spread. And looking at the difference between the bid and the ask, even if we're being generous, it's about 23 cents. Well, you know what? 23 cents isn't that bad after all, is it? You're obviously not going to get it filled at that price because the market's already falling at this point. But it's the idea of thinking ahead of time before you get in. You're going to spend money on this call. What if you're wrong? Or worse yet, you're not wrong. The market just dumps on you. News comes out, a tweet, anything can happen. You get in, the market dumps. What are you going to do? You could sell a call for more money than what you paid for the original call. That would give you a credit spread. Now, keep in mind, this trade could still lose. This is a guaranteed trade. I do have those, and we're going to discuss that in a moment. But what this would do is turn your long call into a short credit spread, right? And that would change your bias. And then you would be asking, well, what's my break even? Well, to calculate break even, you look at the short legs sold and you add the credit collected. Well, in this case, we'd be collecting $23. The short leg is $37.5. So we take $37.5, add 23 cents. Our break even is $37.73. As long as the market stays below that, we would be a winner and we could get that credit. All right, so that's one thing that we could do. Another thing, if we're looking at the losing side of things, is before we even take the trade, ask the question, if I buy this call and the market begins to fall after I get in, what can I do with it? Well, if we had gone a little farther out, instead of using the April 22s, we instead use the April 29s. If I buy this 38 strike call and I'm wrong or the market starts to go against me, I could immediately come one series in and I could sell a call at the same strike. That turned the entire trade into a calendar. Let's just take a moment to look at a calendar. I'm going to throw this over into the options chain or into the risk profile. Let me turn off a trade that I already had in there. And this is the shape of the trade that you're now in. And you can see that there's a wide area that you could land in that wouldn't necessarily be a great amount of profit, but it most certainly isn't a loss, right? And we're talking about being able to sustain the trade maybe for a day or two and just let that decay help cover the cost of the original trade that you had, just like that. So it's approaching it from an idea of, yeah, I know I can close it, but what else can I do? If I get in, the market starts to go against me. You know, I mentioned selling the 38, but we don't have to sell the 38. If we already owned the 38, we could sell the 38.5, or we could sell the 39. We could even get into the money and we could sell the 37.5. Any of those would be a viable choice, especially if we're only going to hold the short leg for a small period of time, say a 2 or 3 days. The idea is that if I spent $94 or $91 in this case, if I spent $91 and I got that on the mark, I'm looking for a way to recover some of that loss and maybe even hold the trade long enough to let it prove me right. Because in this situation, we can get out of that short later on and still have the long on for a rally back up. How many times have we seen the market dip down through the morning and then rally back up in the afternoon or rally up the next day? This would allow you an opportunity to see your losing trade turn around and become a winner, or at least just give it time to prove you right. And at the worst, it locks in the difference between the one you sold and the one you bought. The difference between those two, that would be your loss. So in this case, instead of losing $90, we would only lose Suppose we sold to 38, we would only lose, $24, $21, right? It's not a perfect situation, but it does solve the problem, right? It helps come to a conclusion about what am I going to do if I bought this option and then the market starts to go against me. So a little bit of trade management on the losing side. But you know what's more fun to talk about as winners? So suppose I bought that 38 strike call and the market starts running really good. And I decide it's time to take some profit, but I don't really want to close the trade because I honestly, in my secret little heart, believe it's going to keep running. Well, what am I supposed to do? I only have one. I don't want to close it, but I don't want to lose my profit. Well, what you can do is you can sell an option. Sell it for more money than the one that you bought and lock in a guaranteed credit while still holding the trade to see if it can give you more. Think about the shape of a debit spread. So if I was going to open a debit spread, I would buy one at a higher cost and sell one at a lower cost. And the difference between those two is the debit cost. But in the situation that I'm talking about, if we bought the original option for $91 and then the market makes a good move and I can sell a farther out option for more money than the option that I bought, I'm now holding a trade that is shaped like a debit spread, held as a credit, and cannot lose, right? It has a minimum profit and then it has a maximum profit, but it has no loss at all. There is absolutely no way you can lose that trade. I do this quite a bit in the SPX just because that thing is so big. The last one that I put on this way, I bought a put, and within 11 minutes, I was able to sell a put farther out of the money for more money than the original one that I bought. And the difference between them was $1 in credit. Then the market continued to fall, and I ended up closing the entire trade for $540. I ended up closing it a day later, and I didn't have to worry all that night. I slept like a baby because I was holding the trade for $1 credit. I could not lose. So this idea is management choices. I could trade any option at any series on any expiration. And if I'm going to day trade, which one am I going to pick? Well, as I'm making that decision, I want to consciously be thinking about which option am I going to sell if this trade starts to prove me right, and if this trade starts to prove me wrong. Now, a lot of times I don't do this. I don't do it all the time, but we never quite know when it's going to be one of those days where we see a market just make a really big move. We think it's going to be a reasonably good sized move. Maybe we think we'll get a good 0.5% or 1% move, but there's just some days we get in the trade and it really goes. Hey, why close that down? Why not just hang on to it? Give it time to make you even more money. Well, to do that, we have to make sure that it's not going to come against us while we're sleeping, or just later in the day, watch our gains fade away. So when we're thinking about a trade like that, we want to approach the entry with the exit already in mind. Guys, I appreciate your time. I hope you enjoyed this video. Options day trade tip number 3, management choices. Really consider selling an option against the one that you already have to manage your risk and or manage your profit. I appreciate you guys. I'll see you at the next video.